September 2008, a 158-year-old bank collapsed overnight. $600 billion vanished, and with it, millions of jobs, homes, and futures. But the real story didn't begin with greed or corruption. It began with a lie so simple you could fit it on a billboard. Why rent when you can own? Back in 2002, America was still nursing a hangover from the dot-com crash, and 9/11 had just sucker punched the economy. Fear ruled the market, but the Federal Reserve had a cure: slash interest rates to near zero, make borrowing easy, and let cheap money flood the system. And suddenly, the new American dream wasn't freedom, it was flipping houses. Congratulations, you're approved for $500,000. But we only make $40,000 a year. No problem, adjustable rate, balloon payment, ninja loan. What's a ninja loan? No income, no job, no assets. Still approved. Banks were throwing money like confetti. If you had a pulse, you had a mortgage. Down payments were optional, credit checks were optional, and common sense was completely gone. Buying a house became a national sport. Your neighbor bought one, you buy two. His house doubled in value, yours would too. Even part-timers and baristas with $5 in savings became real estate investors. It wasn't about homes anymore, it was about lottery tickets with driveaways. But every gold rush hides rot. The mortgages being handed out were junk, high risk, barely verified, filled with fantasy numbers. And on Wall Street, they saw opportunity. They bundled those garbage loans together, called them mortgage-backed securities, and sold them to investors as safe, shiny assets. AAA rated, the gold standard, except it wasn't gold, it was fool's gold. Because the ratings agencies giving those perfect grades, they were being paid by the very banks they rated. Imagine grading your own exam and giving yourself an A+. Still, Wall Street wanted more, so they chopped the same toxic loans into pieces, repackaged them into collateralized debt obligations, and sold those too. It sounded smart, complex, safe, but in reality, it was a Jenga tower built out of lies. Yet, a few people looked closer. They read the fine print. They saw the cracks, and instead of joining the party, they asked, what if we bet against it? The big banks laughed at first. You want to bet against the housing market? That's cute. But then they realized that they could make money from it, so they built something new: credit default swaps, insurance that paid out when those loans went bad. And the craziest part, you didn't even have to own the loan to insure it. It was like buying life insurance on your neighbor's grandma and secretly hoping she tripped on the stairs. The whole system turned into a casino, and every bet made the tower taller, weaker, and far more dangerous. By 2007, the cracks became fractures. A few missed payments turned into thousands, then millions. The so-called safe AAA bundles started to rot from the inside. Banks suddenly realized they weren't sitting on assets, they were sitting on grenades. Panic spread, hedge funds collapsed, credit markets froze, and then came the explosion. Lehman Brothers, a 158-year-old institution, gone in days. If Lehman could die, anyone could die. Overnight, the financial system stopped breathing. Businesses couldn't get loans, families couldn't pay mortgages, retirement accounts evaporated. The global economy didn't slow, it flatlined. Within weeks, the chaos spread worldwide. Iceland's banks collapsed, Tokyo's markets crashed, Europe went into panic mode. The dominoes fell one by one until the question wasn't who's next. It was, is the entire system broken? The US government faced an impossible choice: let it all burn or save the arsonists? They chose the latter. $700 billion. That's how much taxpayers handed to the same banks that caused the fire. They called it the Troubled Asset Relief Program, a nice name for a $1 trillion bailout. AIG, GM, Chrysler, everyone lined up. The Federal Reserve printed money like never before, buying up toxic assets under a new policy called quantitative easing, which basically meant patching a sinking ship with $100 bills. And somehow, it worked. For a while, markets stabilized. Wall Street breathed again. But Main Street got ashes. 8 million jobs gone. 4 million homes foreclosed. $19 trillion in household wealth raised. Families who had never missed a payment suddenly owed more on their homes than the home were worth. And not a single major Wall Street CEO went to jail. Not one. They kept their bonuses, their penthouses, their yachts, while millions stood in unemployment lines and soup kitchens. Then came the backlash. 2011. Zuccotti Park, New York City. Thousands camped out, holding signs that read, "We are the 99%. The message was simple. The system isn't broken. It's built this way. Profits are privatized. Losses are socialized. The powerful get rescued. Everyone else gets wrecked." Because 2008 didn't just crash the economy, it crashed trust. It taught a generation that when the rich gamble and lose, the poor pay the bill. And maybe the scariest part isn't that it happened, it's that it could happen again, because the next crisis won't look like the last one. It'll look safe, profitable, and normal, right up until the moment it isn't.